Before we dive in, nothing you hear today is financial advice. I'm not your advisor. Do your own homework. But stick around, because these 7 principles could change how you read every market open from here on out. It's time for Market School, where we break down the forces that actually move stock prices before you ever place a trade. Earnings surprise the market most because stocks don't move on good or bad numbers. They move on the gap between what Wall Street expected and what actually showed up on the income statement. Supply and demand set prices, plain and simple. When more buyers pile in than sellers at a given level, the price climbs. And when sellers overwhelm buyers, it drops, regardless of what any analyst's model says. Interest rates ripple through everything, because when the Fed shifts borrowing costs even a quarter point, it reprices mortgages, corporate debt, and the discount rate on every future dollar of earnings across the entire market. Sentiment often trumps fundamentals. A stock can have pristine financials and still sell off hard if fear takes hold, because in the short run, markets trade on emotion before they trade on spreadsheets. Big players create big waves. When institutions, hedge funds, and sovereign wealth funds rotate billions in or out of a sector, their sheer volume can drag prices far beyond what the underlying business justifies. Welcome back to Market School Continued, where we finish the playbook with 2 more forces you need on your radar. News is priced in instantly. By the time a headline hits your phone, algorithms and institutional desks have already repositioned, which is why buying the headline usually means you're the last one to the party. Options flow amplifies moves, because when dealers sell massive call or put contracts, they hedge by buying or selling the underlying stock. And that hedging activity can accelerate a rally or a sell-off well beyond its natural range. Here's the bottom line. Day-to-day price swings are driven by shifting expectations, not just hard facts. And once you understand that stocks react to surprises rather than absolutes, you stop panicking when the market looks irrational. Because the real edge was never about predicting the news. It's about knowing what's already baked into the price. If this breakdown sharpened how you see the market, do me a favor. Hit subscribe. Drop your take in the comments, because I genuinely read every single one. And ring that bell so you never miss a pre-market session with this community. One more time. This is education, not financial advice. Always do your own due diligence and consult a licensed professional before making any investment decisions. Now hit that subscribe button, and I'll see you at the next open.